Brian Levitt is global market strategist at Invesco. And Brian, of course, stocks have become so disconnected, it seems anyway, from underlying fundamentals that you almost wonder whether the shape of the market recovery is even relevant at this point. But in terms of the economic recovery, give me your current thinking around that, because we do have some evidence, of course, that we've bottomed out, and yet we still have fear of fallbacks.
Yeah, so this is a new cycle. So the deepest and sharpest recession will also be the shortest. So a new cycle is emerging. That's from massive policy support and some credible ways to reopen and re-engage with the economy. It doesn't mean it's going to happen, in a straight line. It'll come with fits and starts. It'll be intermittent. There'll be times where we'll be digesting higher new cases and have concerns about it. But the reality is we know a lot more about this virus than we did, call it 10 weeks ago. And we know that if we exhibit appropriate behaviors, we can re-engage. I mean, where I'm sitting in the New York tri-state area, cases have stayed largely compressed, and the Empire Manufacturing Survey showing what many would say is a V-shaped recovery. So I don't think it's V-shaped for everything. I think it's going to take the appropriate reopening policies to get us there. But ultimately, this new cycle will continue to progress.
And what are you looking for to see it progressing? And I guess when I say that, Brian, what I mean is we could face setbacks, of course. And the most important one, obviously, that's on our minds is a health one. The pandemic could worsen. Are you keeping your eye on that and trying to factor that into your economic outlook?
Yeah, of course. And it's not only just looking at cases. I think we want to be clear that we want to be focusing on the severity of those cases. So we want to be looking at hospitalizations, and we want to be looking at deaths as well. So as an investor, I wouldn't get too caught up in the number of cases, but far more focused on the severity of them. And, from there, then what you want to see is that, parts of the country that have had a first wave, like New York and New Jersey, can they continue to keep it compressed like we've seen in other parts of the world, like Korea and like Italy? And as that's happening, does mobility continue to pick up? I mean, these markets really bottomed when the mobility indices bottomed. And as they've recovered, the markets have recovered along with them. And of course, policy support. And you've seen the Federal Reserve have its intended effect. Inflation expectations up, commodity prices stable, the dollar a bit weaker, corporate borrowing costs lower. So it's not perfect, but all of that comes together to support an economic recovery.
One of the things that we don't really know yet, of course, is what happens to many businesses and consumers once various forms of government support are withdrawn, and what the hangover effect of the Great Shutdown is. So we have, just for example, we have yet to see the many restaurants that will go out of business. We know that they will. We've been told that many will. They haven't yet. And so that's data that has yet to really show up for us. Have you worked all of that in, or do you have to just keep watching the most high frequency indicators to try to stay ahead of it?
Yeah, I mean, look, the market priced in a disastrous economic outcome, and bear markets tend to presage the recession, and so we had the S&P 500 goes down 35% in 20 days. The average recession bear market's usually about 40% in 20 months. So we did it all over a very short period of time, and we would have gone down a lot more, in my opinion, had it not been for the massive policy response. So, it's not as if these markets are trading unaware of what it means for smaller businesses or what it means for the restaurant industry or other industries that are going to be particularly impacted or are being particularly impacted by that. You're going to need more fiscal support to continue to bridge businesses through this period. And as an investor, you're going to have to be selective to think about what does best in this type of an environment. And, unfortunately, there are some components of the economy that may not ever recover to the extent that we were at. But there's other parts of the economy to look at that are showing signs of meaningful improvements from where we were just a handful of weeks ago.
So then, to your point, if we're at the beginning of a new cycle, where are you best positioned for a cycle that starts, even with that might be starts and stops and some dips ahead? Where do you want to be?
Yeah, I mean, as cycles progress, you know, from the early stages, you want to be part of those early cyclical parts of the market. So In the near term, could you have some churn in the market, volatility, larger cap, quality, defensive outperform? Sure. But as this gathers momentum, you'll want to be exposed to the early cyclicals. You'll want to be exposed to small cap and the deeper value parts of the market that have been particularly beaten up as a result of this. That value recovery tends to happen in the early months of a news cycle, and that'll give way, in my opinion, to a similar environment to what we saw in the aftermath of '08. So, as that recovery becomes a very, very slow expansion, we'll be back to wanting to favor the true growth companies globally, wherever you can find them.
Does that take you then back into emerging markets, which we've seen investors kind of shunning a little bit?
Yeah, emerging markets would do well as part of that recovery phase of the cycle. And, what the emerging markets would benefit from is a weakness in the dollar that we haven't seen that we did not see in the aftermath of the financial crisis. And so, the Federal Reserve is working hard to weaken the dollar and reflate the economy. That should enable capital to start to flow internationally. And the emerging markets are trading at relatively cheap valuations and are likely to post stronger growth rates and have higher interest rate differentials compared to the U.S. So, yeah, that type of a recovery phase would favor the emerging economies. I think longer term, investing in the emerging economies, so you want to be very focused on growth. I don't think that this is a commodity super cycle, or a time where we want to own state-owned banks or that type of thing. It's going to be looking into the emerging economies for true growth businesses.
And speaking of commodities, obviously, I think we're really waiting for a demand recovery to see improvement in the price of oil. But when we think about gold, it's been quite a run and a bullish one for gold. Do you see that sustaining, or does that give up the ground that it's gained?
Yeah, gold does well when obviously there's uncertainty, but gold also does well when there's no opportunity cost to owning it. And there hasn't been, because their real yields are pretty negligible across most of the developed world. I would expect as the recovery takes hold, interest rates start to back up a bit and there becomes some opportunity cost to owning gold. So I don't think gold goes up in a straight line. I think it served itself well as a hedge, and it benefited from there being very low rates globally. But as real yields pick up in the United States, as I suspect they will, then I think gold becomes a bit less enticing.
Great to have you with us, Brian. Appreciate it. Brian Levitt is a global macro strategist with Invesco.